At 2:14 a.m., a bank approved a credit card application. On the surface, there was nothing unusual about it. Applications are processed every second, evaluated by systems designed to detect risk, verify identity, and ensure everything follows strict financial protocols. This one passed every single check. The applicant had a perfect credit score, a clean financial history, no criminal flags, and no suspicious behavior patterns. Every data point aligned exactly the way the system expected. It was, by all measurable standards, a flawless profile. But there was one problem. That person didn't exist. There was no real face behind the identity, no physical presence, no real history that could be traced back to a living human being. No childhood, no past, no actual life. And yet, in the eyes of the system, none of that mattered, because the data was valid, the numbers were correct. The signals matched what the system had been trained to trust. And just like that, an invisible identity was granted access to money. Over the past few years, something deeply unsettling has been unfolding inside the global financial system. Banks are no longer just defending against hackers trying to break in. They're facing something far more subtle and far more dangerous. They're being manipulated from within their own rules. Not by insiders, not by traditional criminals, but by identities that were never real in the first place. These identities have names that sound natural, credit scores that look impressive, and financial histories that appear completely legitimate. They exist in databases, in reports, and in decision-making systems. Some even have social media profiles, complete with photos, posts, and interactions that make them seem human. But none of it is real. They were never born. They were created. And as this invisible network has expanded, it has quietly evolved into one of the fastest-growing forms of financial fraud in the world, reaching an estimated value of over $23 billion. Not through dramatic heists or obvious scams, but through something far more dangerous, something that blends perfectly into the system. This is the rise of the ghost profile. In the beginning, there were no alarms, no red flags, no urgent investigations. Everything appeared normal because everything was designed to appear normal. The accounts didn't stand out, they blended in. A young professional applying for a starter credit card. A new customer opening a savings account. A borrower requesting a small loan to build credit. These were routine activities that happened millions of times every day across financial institutions. What made these accounts different wasn't obvious at first. In fact, it was the opposite. They were too perfect. They paid their bills on time every time. They stayed within their credit limits. They didn't make unusual transactions or trigger any risk alerts. They behaved exactly the way financial systems are designed to reward. To the algorithms monitoring them, these weren't just acceptable customers, they were ideal ones. The kind of profiles banks want more of: low risk, high reliability, predictable behavior. But over time, subtle patterns began to emerge. Analysts reviewing data across multiple systems started noticing similarities. Not enough to trigger immediate concern, but enough to raise questions. The same type of customer profile kept appearing in different places. Different banks, different cities, even different countries. They all shared the same characteristics: clean histories, fast approvals, flawless activity, no deviations. And then, after months of consistency, something strange happened. They disappeared. Not gradually, not with warning signs, but suddenly. Accounts that had been perfectly maintained went silent. No activity, no communication, no response. At first, it looked like ordinary account abandonment. People move, change banks, or stop using certain financial products all the time. But when investigators looked closer, they realized this wasn't random. It was coordinated. And that's when the pattern became impossible to ignore. What investigators uncovered next revealed a pattern that was both simple and deeply calculated. These accounts weren't being abandoned. They were being used very deliberately for a final phase known as the bust-out. For months, sometimes even years, these identities operated quietly. They built trust with the system. They established a positive credit history. They increased their limits gradually, just like any responsible user would. They interacted with the financial system in ways that strengthened their credibility over time. Then, at a precise moment, everything changed. Within a short window, often just hours or days, the accounts shifted from perfect behavior to aggressive activity. Credit cards were maxed out. Loans were fully withdrawn. Lines of credit were exhausted. Insurance claims were filed. Funds were moved rapidly across different accounts and institutions. The activity was fast, coordinated, and highly efficient. And then, just as quickly as it began, it stopped. The accounts went silent. No repayments were made. No follow-up activity occurred. The identities simply vanished. When banks attempted to investigate, they ran into a dead end. The addresses didn't lead to real residences. The contact information didn't connect to real individuals. The identities had no physical presence, no verifiable human origin. There was no one to question, no one to arrest, no one to hold accountable, because there was never anyone there to begin with. This type of fraud represents a shift away from traditional identity theft into something far more sophisticated. Instead of stealing a real identity and misusing it, criminals are now creating entirely new ones through a process known as synthetic identity fraud. It begins with a small piece of real data, often a social security number. These numbers are frequently taken from individuals who are less likely to notice unusual activity, such as children or elderly individuals who aren't actively monitoring their credit. From there, the process becomes increasingly artificial. A name is generated using AI systems trained on real-world naming patterns, ensuring it sounds natural and regionally appropriate. Then a face is created, not copied, but generated entirely from algorithms. These faces are designed to look realistic, with natural features and imperfections, but they don't belong to any real person. Next comes the backstory. Employment records are fabricated. Addresses are assigned. Phone numbers and email accounts are created. In some cases, entire social media profiles are built, complete with photos, posts, and interactions that simulate real human behavior. The result is a fully constructed identity that exists across multiple systems. Once the identity is built, it is introduced into the financial system through small, low-risk applications. A basic credit card, a minor loan. If approved, the identity begins to establish legitimacy. Over time, it grows stronger, more credible, more trusted. At that point, it becomes indistinguishable from a real person, at least to the systems designed to evaluate it. What makes this threat particularly dangerous is its ability to scale. With advancements in artificial intelligence, the process of creating synthetic identities can now be automated. Instead of building one identity at a time, fraudsters can generate thousands, each with unique variations, each designed to pass validation checks. This transforms fraud from a manual operation into an automated system. A network of identities can operate simultaneously, building credit, interacting with financial systems, and eventually executing coordinated bust-outs. Because these identities don't physically exist, they don't leave traditional traces. There's no single point where the system can easily detect or stop them. Financial institutions have attempted to respond by introducing advanced verification methods. Face recognition, selfie verification, and liveness detection were implemented to ensure that users are real, present individuals. For a time, these measures slowed the fraud. But once again, the system was adapted against itself. Fraudsters developed techniques known as injection attacks, where instead of presenting a fake face to a camera, they bypass the camera entirely. They inject pre-generated or AI-created video feeds directly into the verification system, making it appear as though a real person is present. These digital identities can pass checks without error, without hesitation, and without the imperfections that typically reveal fraud. And beyond the financial damage, there is a human cost. Because these identities are often built using fragments of real data, innocent individuals can be affected. A child's social security number may be used to build a synthetic identity that accumulates debt. Years later, when that child becomes an adult and applies for credit, they may find their financial history already damaged. The consequences are real, even if the identity causing them is not. What we're seeing is no longer just a fraud problem. It's a structural challenge to the way financial systems operate. These systems are built on trust in identity, trust in data, and trust in the processes used to verify both. But when identity itself can be artificially constructed, that foundation becomes unstable. Detection systems struggle to adapt. Real customers may be flagged incorrectly, while synthetic identities pass through unnoticed. The balance between security and accessibility becomes harder to maintain. As the technology behind these schemes continues to evolve, the scale and complexity of the problem are expected to grow. Estimates suggest that losses could exceed $50 billion in the coming years. But the larger concern isn't just the financial impact. It's the possibility that these systems could become fully automated. If artificial intelligence can create identities, manage them, and optimize their behavior over time, then fraud becomes a continuous, self-improving process. A system that learns, adapts, and operates without human limitations. And somewhere right now, another application is being reviewed. The data appears valid, the identity looks real. The behavior aligns with trusted patterns. There's no clear reason to reject it, so it gets approved. Another account is opened. Another identity enters the system. Another ghost moving silently through financial networks. And no one realizes there was never anyone there. The real question is not whether this is happening, it's how often. And whether one of those identities could already be connected to you. Because in this system, you don't need to be hacked to be used. You just need to exist in the data. And if you want to understand how deep these systems go and what's really happening behind them, make sure to subscribe, because the next story might already be unfolding, hidden inside the system itself.